With this strategy, he understood the market reversal as quickly as possible. The Fair Value Gap (FVG) strategy from Lux Algo focuses on identifying inefficiencies or gaps in price action. These gaps occur when the market moves quickly, leaving little to no trading activity at certain price levels. These inefficiencies are important because they often represent areas where price may retrace or consolidate, offering potential entry or exit points for traders. Key concepts in the Fair Value Gap strategy. 1. Fair Value Gap definition. A fair value gap refers to the space between consecutive price candles where the price doesn't fully overlap. Typically, this happens during strong directional moves, indicating an imbalance between buyers and sellers. Second, price imbalance. Lux Algo emphasizes that price is likely to revisit these gaps to fill the inefficiency. In technical terms, the market seeks equilibrium, and price often retraces to test these unbalanced areas before resuming the trend. Identifying gaps, traders using the FVG strategy focus on spotting these gaps in price action between 2 or 3 consecutive candles. In particular, bullish fair value gaps occur when there's a gap left during a rapid upward movement, and price is expected to retrace to that gap before continuing higher. Bearish fair value gaps occur in a similar way, but during a sharp downward move, where price retraces to the gap before continuing lower. Thank you for liking the video. Let's go to the most important strategy from which you can learn a lot. 4. Price ranges and zones. The specific price ranges around the fair value gap are important for trading decisions. Gap entry point. This is the price level where the gap starts. Traders often use this as an entry level when they anticipate the market will fill the gap. Gap, midpoint. The midpoint of the gap is a key level to watch for potential reactions. It can act as a significant support or resistance area, depending on the trend. Gap, exit point. This is where the gap ends. Price often revisits this level before resuming its previous trend direction. 5. Confluence with other indicators. Lux Algo recommends using fair value gaps in conjunction with other technical indicators, such as support and resistance levels, trend lines, or volume. This combination improves the accuracy of the strategy by confirming the likelihood of price revisiting the gap and then reversing or continuing the trend. 6. Risk management. As with any strategy, risk management is crucial. Traders should consider placing stop-loss orders either slightly outside the gap to protect against invalidated setups or using the next logical support resistance level as a stop. Important price ranges in the FVG strategy. High volume nodes. When the fair value gap aligns with areas of high trading volume, high volume nodes, the price is more likely to respect that zone. Low volume nodes. Gaps that occur in low-volume areas often result in quick price movements once the gap is filled, as there is little resistance in these zones. The Fair Value Gap (FVG) strategy from Lux Algo is a highly effective approach that capitalizes on inefficiencies in price movement often found between candles during strong market trends. These gaps indicate imbalances where price hasn't traded, and they serve as critical areas for potential retracement. Traders focus on key price ranges within the gap, including the gap entry point, midpoint, and exit point, as these are often used for precise trade entries and exits. Combining the FVG strategy with other tools such as support and resistance, volume, and trend analysis enhances its effectiveness and helps in risk management by confirming potential market moves. Thank you for watching the video so far. I hope you can make the most of it. Watch the video related to the strategy.